The beauty of starting to lend when I did, it was really simple, and we
Mm.
did everything manually, right? So we actually understand people of my generation that started out, with the good old Texas Instrument calculator that I still have.
Oh, you got
Souvenir.
the old one. That is awesome. That's how
I
I
keep
know you're
it
old
as a
school.
souvenir.
Yeah. So I've been getting a lot of renewal notices being sent to me from people who have been in static variables and adjustable rate mortgages for quite some time. And it's really picked up in the last few weeks. And a lot of people are saying my amortization is so large. I've got a lot of people that I see on the news and on social media saying, hey, look, no lender's going to be able to love you for who you are. They just simply can't take you. You're going to be stuck at your existing lender. But of course, we know that that's not true, that there will be options for you. So joining with me today to talk about some of those options that may exist for you is David Armstrong from Manulife Bank. David, thanks for joining us on the channel. Who are you and why should we listen to you?
Thanks for having me, Conrad. I appreciate it. Well, if you look at the number up on that wall there, that 230, that's actually the numbers from the front of my grandfather's house in Winnipeg, 230 Collegiate Street. And that is when, as a child, I first learned what a mortgage was, because my grandfather had a couple of small private mortgages. And he had a little green ledger book. And every month he would get checks from his customers and he would enter it into the little green ledger book. And so, probably about the time I was 10 years old, is when I first learned about mortgages. But I've been in this industry since the late 80s. And I underwrote my first mortgage broker mortgage when I was working at a little sweatshop trust company in downtown Edmonton, probably in the early 90s. And we underwrote broker mortgages for Alberta and Saskatchewan at that time. So I've been in the industry a long time. I've been a banker. I was a broker in Alberta for 8 years, and now I'm out here in beautiful Victoria on Vancouver Island, and working for Manulife, which is a fantastic company, and I think I bring a lot of experience to the table. So I'm hoping that what I bring to the table is some years of experience and can maybe speak to this subject that is stressing a lot of people out.
Right. And it really is stressing a lot of people out because like I said, in the social media, in the regular media as well, there's a lot of people going on and being like, look, these people are going to have no place to go. They started maybe with a 23-year amortization, and now they've got a 40-year amortization, and no lender's going to possibly be able to take them on. But we also know that the conversation is actually a little bit more complex than that, because not only do you have some individual nuances, but people will generally fall into different buckets, right? Because it depends on loan to value, how much of a mortgage you have relative to the value of your house, which, depending on which market you're in, may be different and might have adjusted if your housing prices come down if you're in certain markets. We also know that if you're insured versus uninsured, that might be different. If you have a collateral charge versus not a collateral charge, the answer might be different. And so I just kind of want to peel back some of the layers on that so that people can kind of get an idea of, hey, that sounds like that would be my scenario. And so, hey, maybe there's options for me. So let's maybe start with the one which probably has less options available to it, and that's the insured high ratio stuff. So for people who aren't familiar with that, that's the people who have loan to values of more than 80%, so they put less than 20% down in the value of their house, and they're through some kind of default insurer, CMHC, Sagen, Canada Guarantee. So let's say, they went that static variable route. It's unfortunate. They missed out on historical low rates, but now they're coming up for renewal. What do they do?
Great question. So first of all, let's address what I think is the big elephant in the room, the one that gets a lot of play online and in the media, and that is that negative amortization, or my amortization has increased so much because rates have risen. So that's not really an accurate statement. Your effective amortization with your current payment structure has increased. But your contractual obligation is still the same. So if you want to reduce your amortization, you simply have to increase the amount you're paying on your mortgage. Now, if you're coming up for renewal, you're going to have a couple of options with an insured mortgage. Now, assuming that you're still at a loan to value of greater than 80%, so you have less than 20% equity, you're going to have to move that mortgage as an insured mortgage. Now, lenders will take you in because your mortgage is already insured. So the insurer in the background has already placed that insurance. You paid for that premium when you took that mortgage out. So as long as your debt service ratios fit the stress test mold, you'll be able to move that mortgage from lender A to lender B or renew it where you're at. Now, what can you do at renewal to bring your payments down? Now, first of all, if you don't prepay onto your mortgage, your payments obviously at renewal are going to go up. That's going to happen for everybody if they're renewing this year, whether they're in a fixed or in a variable, because rates have risen, right?
Yep, right.
And this negative amortization, they make it sound like the sky is falling, but really, how long have we been in these higher rates?
Like quite some time, like it's almost 8-9 months now, right?
So 8-9 months, but 8-9 months worth of interest and loss of principal payment in that first 5 years of your mortgage isn't a huge amount of money. So the impact on some of these mortgage isn't going to be as big as some people are because you're in a variable. The impact is going to be because the interest rate is going to reset to a higher amount.
Right.
That's the impact. Now, a new lender, when you transfer your mortgage, they're going to have to stick with the original contractual amortization. So you're going to, when you come up for renewal, your amortization is going to be reset to 20 years, assuming 5 years has gone by, say on a 25-year mortgage,
Yep.
and your payment will go up. If you have some cash, you could prepay your mortgage prior to maturity. That will bring your balance down, which will then, of course, reduce your renewal payments. And if you're going to do that and shop your mortgage to find, your best renewal rate and move it, you're going to want to prepay it before the maturity date at your existing lender.
Using prepayment options, or can you time it for your renewal date?
You're best to use your prepayment options. It gets a little tricky when you're trying to time it with your renewal date. But some of the title companies that handle many of the switches for us financial companies will allow you to prepay it right at the switch. But it's much easier if you do it with your existing lender if you have prepayment options.
So now let's ask the most obvious question based on having heard all that. You come up for renewal, but I don't have extra money to pay down against my house because times are tight, right? What then? Are they like, okay, now I'm stuck because I can renew at the contractual obligation, but I don't have the extra money to pay down to where I should have been? What then?
No, you can still move the mortgage as long as you fit the stress test mold. So again, we have to qualify you based on the new mortgage amount. So the amount that's coming up from maturity and the remaining amortization. So if there's 20 years, again, using that, we're making a lot of assumptions that everyone's in a 25-year mortgage with 5 years gone by, but it just makes it simple for conversation's sake. And so assuming you've got that 20 years left, we're just going to take your balance at maturity, re-amortize it over 20 years, calculate your new payment, see if you qualify for that underneath the stress test, and then we can move the mortgage over. The insurance that you have on that mortgage is going to come with it. So we're okay with the fact that you haven't paid down as much principal as you would have previously because we've got this insurance backing us on a high ratio switch.
Which makes sense. And one thing too that I want to point out is you made a differentiation there between effective amortization and contractual amortization. And I find because the effective amortization is really the sensational clickbait thing, the thing that's like, oh my gosh, it's 40 years, right? But I mean, no one was talking about it 2-3 years ago when, someone would enter into a 25-year amortization, right? But then do accelerated biweekly payments and their effective would be 17, right? No one was talking about how, mortgages are being paid off at record rates and like that just wasn't a conversation, right? And so the fact that it's the other way now and people are focusing on that one thing, right, that can easily be reversed because at the moment you up your payments, you're right back down to what they would have been. It's funny. Well, it's not funny to me. I think it causes people unnecessary and undue panic, right? And I think it's also worth noting that distinction, especially when we start talking about, the conventional side of things. Okay, so it's not insured, right? It's not insured and you're less than 80%. We'll tackle that one next. So it's less than 80% loan to value. It's not insured. What are some of the options? And let's talk about both the difference between a collateral charge and a non-collateral charge. And for those people who don't know what that is, there's basically two main ways of registering a mortgage on title: your standard residential mortgage charge and something known as a collateral charge. But David, take it away.
Thanks. Yeah, so most banks and many credit unions register collateral charges now. Most monoline lenders, so mortgage only companies, companies that don't offer lines of credit, etc., they tend to register what's called a standard charge. Now, a standard charge means you always have to stick with your contractual amortization when you switch your mortgage from lender to lender if you want it to be treated as a switch, not a refinance. And that's a big distinction. What's the difference between a switch and a refinance?
Mm-hmm.
Well, a switch means you're just moving mortgage as is from one lender to another, and whoever you're moving the mortgage to will generally pick up the costs to register either an amending agreement or a new mortgage on title. So there's generally no cost to switch your mortgage from one lender to another. A refinance might be where, in the case of a conventional mortgage, again, where you're less than 80% loan to value, is if you want to refinance, add other debt into your mortgage, so on and so forth. And that's a whole new mortgage. Legal fees aren't generally picked up, and it's underwritten slightly differently and has to be in what's called an uninsurable mortgage. So uninsurable means there's a slightly higher rate generally on those products. It's a lot to take in. I know it can be confusing. So like I always tell people, just make sure you're dealing with a really good mortgage broker who understands all of this stuff, and they'll help you weed through it. Now, in the case of a mortgage that's insurable coming up for renewal, now, what makes a mortgage insurable? The loan to value generally needs to be under 80%. So that fits into the insurable and not the insured category. And that's where things get a bit tricky. The property value generally needs to be under $1 million, unless it was purchased prior to an obscure date, which is November 30th, 2016.
That's the date. I didn't even know that. Why?
Yeah. If it was purchased and your current mortgage was registered prior to November 30th, 2016, when they made these changes to
yeah,
insurance,
that's right. The B21.
Then the property value doesn't matter. But generally speaking, it needs to be under $1 million. And if you're just moving mortgage balances, you can get a slightly better rate because lenders have access to what's called insurable pools of funds. You also need to have a really good beacon score to fit that. You need to have a 700 plus beacon score generally to fit insurable. Now, if you're moving a mortgage from point A to point B and you're in a standard mortgage charge and you want to get an insurable rate, you have to keep the same contractual amortization that you have. Doesn't matter if your amortization effectively is higher or lower, you have to keep the same or lower contractual amortization. So let's say, for example, somebody was in a fixed rate and they've been, like you said, making bi-weekly payments and their effective amortization is down to 17, but contractually they still have 20 years left. You can move it to 20. You can keep the 20.
Right. You can bump it back up.
Now, if you're in one of these collateral charges, and these collateral charges are kind of like an umbrella mortgage that many banks and credit unions and some monolines register on title, that allows us to re-advance under a limit that we've registered on your title. If you're in one of these collateral charges and you're only moving mortgage balances, and that can be a first mortgage, second mortgage, and a line of credit. If you're in a collateral charge, you can combine those balances, re-amortize to 25 years, no other debt, no other outside debt, like a car loan or something. It has to be just mortgage debt, and generally get into an insurable product at 25 years again. Now, that'll help a lot of people who are trying to control the bump in payment when they come up for renewal and interest rates have climbed. Now, not all lenders allow you to combine the balances into an insurable product. So again, you'll want to check with your mortgage broker, but that is definitely an option that exists in the market. I hope that explained it.
It does very well. And so I think what people should be aware of is that loan to value is going to play a relatively critical role, right? Because let's talk a little bit about what happens if your loan to value potentially exceeds that 80% mark, right? Maybe it's 85, 90, 95, right? In some cases, it's getting close to 98, 100 for some people, depending on when they bought, what market they bought, the type of mortgage they bought. But let's say now, you have more than 80% loan to value, and you went into this thing originally as a conventional mortgage. Do they have any options?
Generally speaking, if they can't prepay it down below the 80%, they're likely going to be somewhat hand tied to the lender that they're currently at, unless you're aware of somebody that will transfer in a mortgage.
As of right now, no.
Yeah. So I think your options are you have to renew with your existing lender, and or prepay the mortgage to bring it back down under 80%, and then you'll have the option of moving it to another lender if you fit the stress test
Right.
again.
So just
And
even more importance as to why you got to pick the right lender right off the bat, just in case you're stuck with them.
exactly, and if you look at what's happening with some lenders in the space, where they've had to increase rates for various reasons, and those rates that they've had to increase are affecting their customers at renewal. So it is important to choose your lender wisely, and I think you always want to work with a lender that has a lot of flexibility, and different options, particularly once you get closer to that 80% loan to value mark.
Right.
When you're in that first mortgage, that 5% down, it's there's not a lot of options to be had other than payment options. You want to make sure you're in a good mortgage, that doesn't have crazy penalties and so on and so forth. But once you get to that 20% equity mark, you're going to want to talk to your broker and work with a lender that can grow with you down the road as you gain equity. So the other thing that people need to keep in mind, if you've got more than 80%, you've got more than 20% equity built up in your property, talk to your broker about looking at an all-in-one type of product, where you can move your mortgage with many lenders into an insurable mortgage. So get an insurable rate, which is generally a better rate than an uninsured mortgage, and then you can add a line of credit as well. And having a line of credit that grows as you pay down your mortgage can provide you a lot of cash flow flexibility in the future. And I think that's for many customers. It's not for everybody, but for many customers, it's a really important option to have once you've got past that 20% equity mark. And there's some really good products in the marketplace. Manulife Bank's
Well,
Manulife
I
One,
actually happen to like the
one of
Manu
them.
one. Yeah, I happen to agree with that. Like we work pretty closely with Manulife Bank with a lot of files, and you're right. First of all, it is not for everyone, right? But who it's good for, it's great for, right? And I find that a lot of the people that we put into Manu ones, that's the all-in-one products with the mortgage and the home equity line of credit component in there. We put quite a few people in them in 2020 and 2021 when things were low, like interest rates were low. We locked in some good low fixed rate, historically low rates, and that was awesome. But we're like, hey, home equity lines of credit, they're a great thing to have when things go south. And sure enough, it wasn't. And it was like a little while later, all of a sudden the shit hits the fan with the pandemic, right? And all of a sudden people are like, oh, the interest rates are going up and we need to like battle inflation. And we saw a lot of people tap into that home equity line of credit and really be a source of saving grace just while people got their feet under them and like got used to the higher payments of things. So it does provide a good cushion.
It really does, and the advantage of an all-in-one account is that limit grows with your equity or with your principal payments portion on the readvanceable portion of the mortgage, and it opens up the ability to reborrow if you run into a cash flow crunch. And if you take the pandemic, for example, a very, very low percentage of our Manulife One customers sought a mortgage deferral because they didn't need it, because they already had access to equity in their home. There was no point in deferring a mortgage payment. So, it's a really flexible product to have, and there's a lot of great other features about the product as well.
Right.
And but I think the main message we want to get across today is that you have options. Sit down, talk to a broker about those options at maturity. And even if you're not at maturity and you're in a variable and you just want to look at options to get out of it, the penalty on variables is generally not that bad.
Mm-hmm.
And you can move a mortgage even though you're not up for maturity in most cases, as long as you don't have a restrictive clause on your mortgage. So it might be worth talking to your broker.
Well, and we always
Even
tell people reach out to us regardless. You don't have to wait until
absolutely.
renewal to have the conversation. We actually keep pretty active conversations with our clients, even if it's just to pick up the phone and be like, "Hey, how's it going? Like, how do you feel about your payments? How do you feel about the market?" And then, most of the time it's stay the course. You're doing great. You got things set up properly. You're fine. But every now and then, we'll have people reach out to us, and it's like, it doesn't matter if your renewal's 3 years from now. Let's start having the conversation now.